Welcome to the deep dive. Today, we're tackling something that seems really ordinary, almost mundane, but it's actually a huge area in the fight against financial crime.
Right, we're talking about monetary instruments.
Exactly. Things like the cash you have on you, maybe traveler's checks from back in the day, money orders.
Yeah, the stuff that's easily turned into cash or used to move value around.
Yeah.
And importantly, not always going through typical bank wire channels.
Right, which makes them interesting. And we're basing this deep dive on a really focused article from FinCrime Intelligence.
It specifically digs into the risks these instruments pose
Right.
in the whole financial crime picture
So our mission today really is to get clear on what counts as a monetary instrument.
and why they're so attracted to criminals. That's a big piece of it.
Definitely. And then look at the systems, the rules, and the practical things banks and others do or should do to stop them being misused.
Yeah, basically, how do we fight back?
And for you listening, understanding this stuff is pretty key, isn't it? If you want to grasp how dirty money moves or how compliance actually works on the ground.
Absolutely. It helps you see those kind of hidden paths that value can take, paths that aren't always obvious digital trails.
Okay, so foundational stuff. Let's get into it.
Well, what strikes you first, reading the source material, is just how broad the definition of monetary instruments can actually be.
Right, especially under regulations like, say, the U.S. Bank Secrecy Act, the BSA.
Exactly. Or similar AML, anti-money laundering, rules you see internationally. It's way more than just physical banknotes.
Yeah, the article mentions the obvious ones like traveler's checks, money orders. We recognize those.
Sure. But it also quickly gets into things that are maybe less common day to day, but carry significant risk.
Like what?
Things like bearer bonds, where just holding the physical bond means you own it. No central registry tracking who has it.
Ah, okay. Physical possession is ownership.
Precisely.
Yeah.
And then various other negotiable instruments.
Okay. What does negotiable mean in this context? Why is that important?
Good question. Negotiable basically means it's easy to transfer ownership, often just by handing it over, sometimes with an endorsement, but without needing, say, the issuer to verify the new owner's identity deeply.
So things like bank drafts or cashier's checks could fit here.
They can, yeah. They can function a lot like cash in certain transactions.
Hmm.
And that ease of transfer, the potential lack of a clear, traceable ownership chain, well, that's appealing if you're trying to hide something.
And technology keeps changing the game, doesn't it? The definition has to adapt.
Totally. The source highlights things like prepaid access cards or stored value cards, essentially, digital wallets or cash carriers.
Right, like with cards, but sometimes reloadable or usable more broadly.
Exactly. And depending on the specific rules in different places, even some types of crypto assets are starting to be looked at under this lens.
Because they also move value,
Yeah.
sometimes with a degree of anonymity.
hmm So the common thread really is that they all represent value. They can be converted or transferred pretty easily.
And crucially, they often have features that make it harder to trace the money's origin or the owner compared to, say, a standard bank transfer logged clearly in two accounts.
You got it. Which leads us straight to the core problem. Why are these instruments such magnets for, well, criminal activity?
What makes them so useful for bad actors?
It's precisely those characteristics we just talked about. Portability, you can physically carry them. Anonymity, or at least relative anonymity, depending on the instrument. And they're widely accepted.
People take them for payment.
Right. So criminals exploit these features. The FinCrime Intelligence piece lays out a few classic methods.
Structuring has to be top of the list, right?
Oh, absolutely. It's probably the most well-known. You take a large amount of illicit cash.
And break it down.
Exactly.
Yeah.
To lots of smaller transactions. Specifically designed to sneak under those regulatory reporting thresholds.
Like buying several money orders, but keeping each one under, what, $3,000 so you don't trigger the basic ID checks?
Precisely that.
Yeah.
Or making multiple cash deposits or purchases just under the $10,000 limit that flags currency transaction report, a CTR. The whole point is to avoid triggering those alerts. Fly under the radar.
And because a lot of these are physical things, cash, cards, paper instruments,
They can travel. Cross-border smuggling is a huge issue.
just physically carrying bundles of cash or bear bonds or maybe a stack of high-value prepaid cards across a border.
Yeah, it's a very direct way to move value without leaving that immediate electronic footprint that authorities might pick up easily from, say, international wires.
Okay, so structuring avoids detection thresholds, smuggling moves it physically. What else?
They're also used to complicate the trail after the initial crime generates the money. That's called layering.
Layering, making it messy.
Kind of, yeah. You might use dirty cash to buy, say, money orders in one city. Then you take those money orders somewhere else and deposit them, or use them to buy something else. You repeat it.
Each step creates distance.
Right. Distance and complexity. Trying to make it really hard for investigators to follow the money back to its illegal origins.
And criminals don't always do this themselves, do they? They use other people.
That's another key tactic, using third parties, often called Smurfs, kind of a nickname.
Smurfs,
Yeah.
like the little blue guys.
Yeah, the term stuck. But these are real people, recruited to do the individual transactions.
So they're the ones going into different banks or stores, buying the money orders, loading up the prepaid cards.
Exactly. On behalf of the main criminal or organization, it just adds another layer of separation. Makes it harder to link the big fish to the actual dirty money.
And then eventually this money needs to look clean, right? It has to get back into the regular economy somehow.
That's the final stage, integration.
Yeah.
You need to make the laundered money usable.
How do monetary instruments play in there?
Well, you might redeem those money orders you layered, or deposit the funds from those prepaid cards into a bank account, or even use them directly for big purchases, cars, real estate, maybe gambling at casinos.
Trying to make it look like legitimate income or winnings.
Precisely. Make the funds appear clean, integrated into the financial system.
Wow. Okay, so structuring, smuggling, layering, smurfing, integration. It's a whole toolkit criminals have built around the features of these instruments.
It really is. It's all about breaking things down,
Yeah.
creating distance, physical or systemic, and using other people as cover. Makes that audit trail incredibly difficult to piece together.
So given all these ways they can be misused, what are the banks, the money services businesses, the places that issue or handle these instruments, what are they actually required to do?
Yeah, that's the crucial next question, and the article makes it clear. Regulators put a lot of responsibility on these institutions.
Which makes sense, but it must be tough. How do you build defenses when the tools being misused are so common, so versatile?
It's a massive challenge. But the source outlines several key regulatory requirements. Things like monetary instrument logs or MIL-Ls in the U.S. system.
PLLs, what are those exactly?
Okay, so an MIL is a specific log you have to keep if someone buys certain monetary instruments like cashier's checks, money orders with cash, and the amount is between $3,000 and $10,000.
Oh, so it's below the $10,000 CTR threshold, but still requires capturing information.
Exactly. You log details about the purchaser and the transaction. The article points out this is vital for spotting potential structuring below that bigger CTR reporting level. It gives investigators data points in that suspicious zone.
Got it. And there's just the basic need to know who you're dealing with, right?
Absolutely. KYC, know your customer. Mandatory customer identification for certain transactions or above certain value thresholds is fundamental AML-CFT practice globally. You have to verify identity to link activity to people.
And what if a transaction just feels wrong, even if it doesn't automatically trigger a MIL or a CTR?
That's where suspicious activity reports, SARs, come in. If a bank teller or compliance system flags behavior, that seems fishy.
Like what kind of behavior?
Like someone clearly trying to structure transactions, or a transaction that just doesn't make sense for that customer, or maybe buying lots of instruments with cash across different branches. Anything that raises red flags.
Then the institution has to file a SAR.
They have an obligation to file a SAR with the Financial Intelligence Unit like FinCEN in the U.S. It alerts the authorities that something potentially illicit might be happening.
Okay. And you mentioned smuggling earlier. What about rules for physically crossing borders with this stuff?
Yeah, there are specific rules for that too. Cross-border declarations are key.
Like at customs.
Exactly. Most countries have a limit. It's $10,000 in the U.S., for example. And if you're carrying monetary instruments above that value in or out of the country, you legally have to declare it.
A direct attempt to counter that physical smuggling risk.
For sure. It gives authorities a chance to ask questions about the source and purpose of the funds.
And underpinning all of this must be record keeping.
Absolutely essential. Robust record keeping is non-negotiable. Institutions have to keep detailed records for years: who bought what, when, how much, with what funds, often including specific serial numbers for instruments like money orders.
You can't manage the risk if you don't have the data.
Precisely. And failing on any of these requirements, MLs, KYC, SARs, declarations, records, can lead to huge penalties for the institutions. Regulators take this very seriously.
Okay, so those are the big regulatory mandates, the must-dos. But just, ticking boxes on a form might not be enough to actually stop clever criminals.
That's a really important point. Compliance isn't just about following rules, it's about effective risk mitigation.
So, what does the article suggest are the best practices? How do institutions go beyond just the basics?
Well, it really emphasizes building a proactive, layered defense. And a key element highlighted is staff training.
Training the frontline people, the tellers, the customer service reps.
Exactly. Teaching them to recognize those subtle red flags we talked about. Customers who seem unusually nervous or who always structure their transactions just below thresholds.
Or maybe they refuse to provide ID when asked, or their story about where the money came from just doesn't add up.
Right. That frontline vigilance, that human element, is incredibly important. They're often the first line of defense.
But humans can't see everything, especially with millions of transactions.
True. That's where technology is critical. Implementing automated transaction monitoring systems is a must for any institution of significant size.
Systems that can crunch the data.
Yeah. They analyze huge volumes of transactions looking for patterns. They can spot things a human might miss, like unusual spikes in monetary instrument purchases by one person across different locations or complex sequences of transactions that look like structuring.
And verifying identity properly seems like it connects everything.
It's absolutely fundamental. You need solid customer identification procedures, CIP, for qualifying transactions. But the source adds another layer. For higher risk situations, it's also about verifying the source of funds.
So, not just who is buying it, but where did their money come from?
Exactly. Trying to ensure the money used to buy the instrument wasn't illicit to begin with. That adds a much stronger layer of defense.
And keeping tight control over the instruments themselves.
Definitely. Robust internal controls are vital. Think strict inventory management for blank money orders or prepaid cards. Clear audit trails tracking every instrument issued, redeemed, voided, whatever. You need to know the life cycle of these instruments within your walls.
Makes sense. And then sort of checking your own homework.
That's a good way to put it. Periodic independent audits. Having someone objective review your monetary instrument sales, usage patterns, and compliance procedures is critical.
Especially focusing on high-risk areas.
Right. Maybe transactions involving certain high-risk customer types or geographic regions known for money laundering concerns. These audits help ensure the controls are actually working effectively.
So it's really about weaving all these practices, training, tech, verification, controls, audits, into a comprehensive AML program.
That's what the article argues is necessary to really tackle the inherent risks these payment tools carry. It's not just one thing, it's the whole system working together.
Okay, so stepping back, looking at the bigger picture here, it's clear that these monetary instruments, they do serve legitimate purposes, right?
Oh, absolutely. They support small businesses, people who don't have bank accounts, international remittances. They're vital parts of the economy.
But those very features, the portability, the relative anonymity, the ease of transfer, that's the flip side. That's what makes them such a battleground in this fight against illicit finance.
That tension is really at the core of it all. They're tools for good commerce, helping value flow.
But they also present these persistent vulnerabilities.
Yeah, vulnerabilities that criminals are actively, constantly trying to exploit using those methods we discussed, structuring, smuggling, using smurfs, all to hide where the money came from.
So I've kind of journeyed through what they are, from simple cash to more complex instruments.
Explored how criminals leverage their characteristics.
And then looked at the defenses, the regulatory must-haves like mills and SAR filings, and the proactive best practices like training and monitoring.
It really highlights this ongoing effort to strike a balance, enabling legitimate use while erecting strong barriers against misuse.
And the source, the FinCrime intelligence article, it kind of leaves us with a pretty significant thought to chew on.
Which is?
It's that regulators aren't just setting down rules and walking away. They explicitly expect institutions to have and maintain really sophisticated, robust systems specifically for detecting, monitoring, and reporting suspicious activity related to monetary instruments.
Right. It's not a one-time setup. It's an ongoing expectation of vigilance.
So the final question for you, the listener, is maybe, what does that constant high expectation from regulators tell us about the sheer scale and the ever-evolving nature of this challenge? How hard is it really to prevent financial crime when value can change hands in so many different ways, sometimes, right under our noses?